if the recent bond market volatility has actually improved the opportunities for advisors and clients? Hi, I'm Samuel Martinez. In this video, we'll discuss what's behind the recent repricing in bonds, why higher yields continue to be supportive for fixed income returns, where active expertise can help uncover opportunities, and how advisors should think about positioning client portfolios in today's environment. Yes, the return tailwind in fixed income is strong. To drive the point home, listen to this. Over the last 25 years, when yields on the ag are above 4%, almost 90% of the time, 6-month forward returns are positive. What's more, when returns are negative, the drawdown severity is 40% shallower than when yields are below 4%. Now, the context around why yields have increased of late is important. The Iran conflict and sticky inflation have remained key drivers of volatility in the market. The recent Fed meeting left the market wanting more clarity about the Fed's reaction function. Fixed income sold off, and investors demanded more compensation for the increase in uncertainty around inflation, Fed policy, and the longer-term path of rates. That sounds like a bad thing, but the repricing improved the prospective opportunity because yields are higher and more of those risks are now reflected. The difference from 2022 is also striking. Clients entered that period with very little income cushion and then absorbed a rapid adjustment in rates. Returning to the stat I shared earlier, based on history at current yield levels, the likelihood of positive returns going forward remains high, and the risk of drawdowns of the same magnitude as when yields aren't as attractive is lower. We have been positive on fixed income for some time, but the opportunity has not just looked attractive, it has been delivering in many respects. Since the end of 2023, 31 of 32 rolling monthly 12-month return periods for the aggregate index have been positive. Put simply, clients have experienced positive 12-month returns nearly every time, and not just a little positive in most cases. Of the 32 rolling monthly 12-month return periods, 50% of periods had returns greater than 5%. So today's higher yields modestly strengthen the return potential, but they do not create an entirely new investment case. The opportunity has persisted through all of the uncertainty in recent history. Advisors and clients haven't needed to perfectly time the market or correctly predict every Fed decision to benefit. We have been consistent in our message because the opportunity has persisted and the results have supported it. Attractive return potential does not mean every part of the bond market is equally attractive. Credit spreads remain relatively tight, rate uncertainty is elevated, and outcomes are increasingly diverging across sectors and issuers. That makes it important to be deliberate about where clients take interest rate and credit risk. The AI-related investment cycle is a great example. The cycle is supporting growth, but it's also creating substantial financing needs across technology, data centers, power, infrastructure. The key question is, which companies can fund that investment responsibly and ultimately earn an adequate return on the capital being deployed? Answering where the best opportunities are requires collaboration among portfolio managers, credit analysts, and traders. Attractive yields create a strong foundation, but expertise helps determine which risks are worth taking and where. Expertise is where the rubber meets the road in terms of active managers being able to deliver outperformance. We're proud that the Vanguard Core Bond Fund is a great example of leveraging our expertise to create value for clients. As of the end of July 2026, the fund delivered 44 basis points annually of net returns over the US Ag. Keep in mind that waiting for perfect clarity carries its own risks. For example, if your duration is too short, you face reinvestment risk and the possibility of having to invest at lower yields if they decline. Also, you don't need to correctly predict the next Fed decision or identify the exact peak in yields to benefit from fixed income. The return opportunity has already persisted through significant uncertainty. Current yield levels bode well for the opportunity to continue to persist. Implementation should begin with the role fixed income is expected to play in the portfolio. Shorter duration strategies can support liquidity and help manage downside risk. High-quality bonds can provide income, diversification, and potential for some downside hedging in a weaker economic environment. Advisors should also consider high-quality active managers to benefit from their world-class expertise. Try and stay focused on the next 12 months as opposed to the next few weeks, and try to let strong fixed income tailwinds that come with higher yields work for you and your clients. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.